Now we are within touching distance of 5950 on the Nifty, and the Sensex is up 410. The author of all this rally was Ben Bernanke. So let's start by giving you a slice of what he said yesterday that cheered markets so much.
We will not raise interest rates until, at least until, unemployment hits 6.5%, as long as inflation is well behaved. Again, I think, as I've said before, that 6.5% is a threshold, not a trigger. There will not be an automatic increase in interest rates when unemployment hits 6.5%. Instead, that'll be a time to think about the situation anew. And given, as I said, the weakness of the labor market, the fact that the unemployment rate probably understates the weakness of the labor market, given where inflation is, I would suspect that it may be well some time after we hit 6.5% before rates reach any significant level. Fiscal policy is now actually quite restrictive. CBO estimates that current federal fiscal policy is subtracting 1.5 percentage points or so of growth from the U.S. economy this year. So you put that all together, and I think you can only conclude that highly accommodative monetary policy for the foreseeable future is what's needed in the U.S. economy. The issue has to do with not so much with the overall accommodation, but rather with the mix of instruments being used to provide that accommodation. Asset purchases, we have thought about, and I've frequently described as, providing some near-term momentum to the economy. In other words, we have said that we are trying to achieve a substantial improvement in the outlook for the labor market in a context of price stability. We've made progress on that, but we still have further to go. But again, that's the objective of the asset purchases, is to provide near-term momentum, to try to get the economy moving forward more quickly.
All right, so that was part of the reason why the market gained, statements indicating that the fall in employment to 6.5 is not a trigger, but probably a threshold. As well, of course, the FOMC minutes indicating that many members wanted more job gains before slowing the bond purchases or slowing the quantitative easing. That at any rate is the takeaway from yesterday's event. Richard Gibbs of Macquarie Securities joins us on the phone line. Richard, this reaction of the markets, do you think this rally can go on for a goodish bit? Has the situation on the ground changed considerably in terms of liquidity expectation?
Look, I think there has been some change at the margin. I don't know if it's changed radically or fundamentally. At the end of the day, the US is still going to be moving to some form of tapering in terms of its quantitative easing operations. It's unlikely to be as substantial and as early as some in the markets had thought, and I think that's what led to the overreaction. And it's also not going to be governed by the calendar, as Bill Dudley was saying last week, and Ben Bernanke again reinforcing that in his comments, but also reinforcing the fact that it is not going to be strictly numerically dictated to by the unemployment rate.
Richard, what's the observation in the currency space? Have we just seen, because we've seen emerging market currencies rally quite a bit, is it just short covering, or at least are you seeing instances of perhaps investors going long in the emerging market risk currencies?
Well, I think certainly there is some currency value there now, because if you look at the rupee, for example, it had it was the worst performing currency in June, as you know, and of course that's really an oversold position on that. So I think we've seen the capitulation in a lot of emerging markets, across asset markets and in the exchange rate markets, and as a consequence of that, we're starting to see a bit more of a reasoned approach, and investors coming back in and looking for some value there, and certainly they can pick up some capital value given the capital sell down we've seen on those exchange rates.
Richard, now when are you expecting the quantitative easing to start to taper, and how much have the markets factored that in?
We met about this last night out of Sydney with our New York people, and we still expect that by November we'll be seeing the early stages of that tapering process being commenced by the Federal Reserve. Fed have been quite active on the ground in New York, really, I suppose, conditioning the bond market, bond traders in particular, for that. Now, people should be very clear on this, as Ben Bernanke said. It doesn't mean that we're going to get an explicit rise in interest rates. What it means is that the asset purchase operation will begin to be wound back in a very orderly fashion. So we would expect that to commence, as I say, in November and move through the outturn of the year into 2014, and I guess probably start to really accelerate as we move through that first quarter, the March quarter of 2014.
Richard, what we've since seen in the past several months has been a long US equities and short US bonds and short emerging market equities. Does that broad trend change now, or is it just put in cold storage for the moment? As well, how much more upside do you see in, for instance, Indian equities and currencies?
I think it becomes much more opportunistic now. I think you're right. We have seen that broad dichotomy existing. But I think we've actually, as a consequence of that, we've seen some oversold positions emerge, and we've seen some companies where really there hasn't been due regard given to their revenue potential and their top-line revenue growth in their domestic markets in particular. And so I think we'll start to see those being sought out as value stocks, if you like, and value sectors around the world. And that really is going to reflect this change in mindset by investors, which has been actually stimulated as a consequence of the tapering operations of the US being considered, and that is away from yield and to capital growth-driven investment. And there will be potential for capital growth in emerging markets, in the Indian market, particularly in those stocks and sectors that have been unduly sold down.
Richard, many experts that we had spoken to over the last few days indicated that they expected the QE to start tapering by September. After yesterday's comments, do you think now the majority or the bias has now shifted from September, perhaps to end of the year, November, as you expect? And is that, as Lata was earlier asking, priced into the market? What is it currently suggesting? A September, November, December, or perhaps even next year?
Well, I think September was far too precipitous, and I don't think that was supported by last Friday's non-farm payrolls either. I don't see how you could have seen the movement in the unemployment rate and the total jobs growth, even 195,000, being consistent with an earlier start to quantitative tapering in the United States. So I think, yes, it has shifted the more excitable elements back out in terms of their time horizon, and I think that's a wise thing. And of course, Chairman Bernanke would be well aware of that, and his comments would be designed to actually try and maintain control of the agenda, if you like, in terms of the commencement of the tapering process.
Very quickly, what's your expectation of FIs in the debt market, in Indian debt market? Will the outflows stop, as we, or perhaps can we see some inflows as a relief measure?
I think we might see some inflows as a relief measure. I think we've got to see some rebalancing overall of global portfolios. I think they have been excessively weighted towards the capital growth side and equities, and the outflow out of fixed income has been a little excessive. So the extent to which we've seen yields normalising, if you like, and bond prices normalising, particularly in emerging markets like India, then I think that's a better value investment prospect then for those fixed income funds to be getting back into.
Right, we'll leave it at that. Thanks a lot, Richard Gibbs, for joining us.